Okay, everybody, good morning. Happy Friday. I hope you're all doing well. I have some good charts for you today in light of what I talked about yesterday with the diverging 10-year yield and the direction of the S&P. As we talked about, usually those things in the post-1980 era moved in the same direction. That is, if the stock market went down, yields would also go down, meaning the actual price of the bonds was going up, meaning yields were a safe haven asset. As we know, that is changing. So I got some, and that's really the key story. I mean, there's no bigger story than that if you talk about world markets. I have some charts. Wanted to start out, though, with a couple updates on just sort of other things that I've been doing, media appearances, I guess you can say. So here we go. This was a couple weeks ago. I was in London on my buddy Peter McCormick's show. He's moved on from his What Bitcoin Did. Danny has taken that over. And, he has a more generalized show, but of course, this is a libertarian audience still. And with libertarian audiences, they, for some reason, tend to have a soft spot for Vladimir Putin, which is highly erroneous, as you know, if you follow me. And I'll never back down from that, of course. But we were going to do macro and money and everything, but I just couldn't help myself. So we ended up doing a lot on Ukraine. Hopefully it sounded okay, or you guys got some good info from it. I haven't even watched it myself. I'm sure when I read these comments, let's check, 125 comments, that they're going to be bad. I'm not even going to do the the masochism of reading them at the moment. Perhaps I'll do a video where I actually read them. YouTube comments, there's some good ones always. But anyway, if you want to watch that, you can watch that. Still on the same topic, this is a gentleman that I really respect, Gabrielis Landsbergis, former foreign minister of Lithuania. He was on a Russian, this is basically Russian dissidents channel, the Russian opposition, the only free Russians, which are outside of Russia and can speak their mind, TV Rain. It's probably the most popular English language programming. Check it out. Gives some good updates. And, she pushes back. This is interesting. This journalist herself is Georgian, has a Georgian last name, but she's Georgian Russian. And, of course, the Baltics as well were part of Soviet Union, illegally occupied. And you're going to get different views, but she's trying to push back on him on, if all Russians are responsible, or what's the level of culpability from Russians versus Putin, the dictator, having a mandate. Does he even have a mandate because all the elections are rigged? Things that, the Western world just has been ignoring for a long time. Now we have a blowhard in the White House, so we're going to see how much longer the, American people might put up with such acerbic assertions at times. But point is, I agree with most all of this guy's views, and obviously I'm in the Baltics as well, so we have a threat, and we're always going to have a threat, and I'm going to talk about it as much as I can as Ukrainians keep shielding Europe, basically, and Europe needs to be doing better. I see this on a recommendation, by the way. Oliver Moody just came up with a great book. It's called Baltic, The Future of Europe. It talks about all the nations that are actually around the Baltic Sea, okay, which is, you got Denmark, Norway, Sweden, Finland, going sort of clockwise around Denmark, Norway, Sweden, Finland. You have Russia, very small component now of the non-NATO border. Then you have the Baltics, Estonia, Latvia, Lithuania. Then you have Kaliningrad, which is a former German 800-year province, Königsberg, which was the headquarters of the Prussians, they became the largest German state, which eventually, Bismarck unified the Germans in the late 1800s. And then you have Poland, which was more like Lithuania, more had an inland polity, not necessarily on the Baltic like the Swedes or the Finns or the Norwegians or the Danes or the Germans. But after the shakeup of World War II, the borders changed and Poland has more of a Baltic presence now. And then Germany. If you keep going around, it's Germany as well that has a border there. Holland and the Netherlands as well, of course, are still in the Baltic. It is the Baltic. So it's basically where the I don't want to say war because it's not a full war yet, but there's hybrid wars going on right now. Sea cables being cut all the time. Washington Post, Jeff Bezos' newspaper, came out with an article maybe a month ago, said it was all an accident, which is quite hilarious. That's not the conclusion of anybody over here. And the war is raging. So this is, trade wars could turn into real wars. This is it's just the scary thing for where we live. If you live in North Dakota, I think you're pretty good. But, where we live, it's a bit more risky. So Trump is done his famous pause. And let me know, guys, if you want to have questions as well, just chime in. But I have some good charts going to share in a second. So Trump did the famous pause. The markets rebounded. And then they slid again. Yesterday, China says it's going to go up to 125% on the U.S. All goods. But they say they won't go higher than 125% from April 12th. Given that there's no longer any possibility of market acceptance for U.S. goods exported to China under the current tariff levels, if the U.S. side subsequently continues to impose tariffs on Chinese goods exported to the U.S., the Chinese side will pay no attention to it. So the big question, and we're going to show, I have some, good macro charts here, but the question, as we talked about, is as the slide has happened, this is a 5-day chart, 5 day, 1 day, all right, yields going back down a little bit. But over 5 days, the fact that basically yields have been going up, even amidst his pause in the S&P rebound, even amidst the pause, yields were going up and markets were going down. Okay? So let's go visit. Whoops, that's not the one I want to show. Let's visit that again. And this is just daily, so it's, not so fine. Zoom it in here. Okay, this is from the start of the year. Here was the pause. Of course, we know that there's a lot of perhaps tomfoolery that's happening here with not only politicians, but connected insiders. People have been talking about big options trades that were opened up just before the announcement of the pause. Markets pumped and people made a lot of money. Now it's back down. Okay. And as of April 11th, we're at, overnight US, but 5268 on the S&P. All right. So what did the 10-year do during that time? Okay. Yields went up. We're still in this. This is the thing. This is the thing. It's not a huge amount, but 4% to 4.5%. This is the thing that's scaring the living daylights out of Besant. All right. So also, I've noticed that Besant is trying to assert himself as the only grown-up in the room. He said he was not part of the tariff calculations. I find that hilarious, as he should. Just throw Lutnick and Stephen Miller and all these guys under the bus who are just making up things as they go. Besant's trying to be the grown-up in the room now. So I want to talk about foreigners. We talked about yesterday, and I guess the day before even, that Japan had been rumored to be the main seller, not just China. But let's look at who are the foreign holders of debt. And actually, before we even look at the holders, I've noticed some interesting discrepancies in the numbers here. So I'm going to show you a macro one, but this is from if you want to check what I'm working with here. This is a typical chart that the Fed publishes, but it's actually from the Treasury. Okay, it's from the It's from the Treasury, but it's only released quarterly. It's not great. But we, as of December, $8.5 trillion of treasuries that foreigners hold. Now, for a long time, I myself thought that this was it, right? Foreign, it says right here, foreign and international investors. It makes it seem like, usually when you say foreign, it's like foreign official. That means foreign central banks, usually. But they also say and international investors. So it makes it seem like this is it. This is the entire holdings of foreigners of treasuries. Remember, we have 36 and change trillion dollars of debt outstanding. So there's the amount that is held by foreigners. I'll put this on a chart comparing them in a second. But I looked a little bit more in the numbers because I was trying to, figure out how big does Japan hold, China, so on and so forth. And you can find various tables. Here's one. This is actually not so new, but this is from December 2023. Okay. And Japan is indeed the biggest. Okay, as of December 2023, and it's the same still today. We've got China at 800 billion, and then the UK, okay, at 679 billion. The top 10 is 4.8 trillion, and then you see here total all foreign investment in federal debt 8 trillion. This was as of December 2023, so we can go back to December 2023, and it's right there, 7.939. 7.946. Okay, it's basically the number. But then if you keep looking, and I encourage anybody to do this, just search Treasury websites. Okay, this is from the Treasury, from a report that they release, which I don't actually have on a screen share, but you can find it. Just search these keywords if you want. All right, Table 2, preliminary data, February 28th, 2025. Okay, and this page, and the data expires, so this is nice, they delete it. Foreign portfolio holdings of U.S. long-term debt securities as of June 30th, 2024. I think this is interesting. This is just a pure discrepancy from the prior slide. So if we go down, now look, there's a couple different charts, or tables. Wanted to make sure I had everything. We got Treasury securities, and then we got agency securities. This is the same thing. These agencies, these are a lot of the mortgage-backed securities, ABS in particular, asset-backed securities, and then we have corporate, okay? But if you look up Treasury, all right, let me see if it balances. Oh, maybe it does, actually. I thought, no. Okay, it does. It does. So it's corporate that is the discrepancy, actually. I wasn't sure about that myself. This is as of June 2024. We have 7 and 1. Okay, actually, I made a mistake on the fly. I thought that there was more, but it's corporate that is not included. So it's this 4 trillion. I was going to say this could be another win for blockchain stuff because, you have these congressional reports sometimes that check the Treasury reports and you get discrepancies in numbers, but it's more or less accurate. 7 plus 1.2 is agency, plus non-asset-backed securities. You're getting something close to, that's 7.1 plus 1.3, let's say, is 8.4. 8.44. And that's close enough, actually. It's going to be close enough to this. And that's going to be close enough in June. Yeah, it's a slight discrepancy, but it's not as big as I thought, actually. 8.2. So it's only 200,000 difference. This is June, according to the Treasury, 8.2. All right, in foreign debt held by foreign international investors. And then if you look at this, again, look, just rounding, 7.1 plus 8.3. Sorry, 7.1 plus 1.3, that's 8.4. So it's actually not as big as I thought. I was thinking about this 4 trillion was going to add on too, but they still don't count it up correctly. All right, it's 8.2 here, and it's closer to 8.5 according to this report from the Treasury in June 2024. So it just shows you, like, these things can be wild sometimes when they, depending on how you define it. And then another exposure, actually, but this is less to the government, of course. This is in the markets. These are like, foreigners owning Apple corporate debt or whatever. That's another 4 trillion. So in any event, I just wanted to show you it can be sometimes you got to pick through the numbers to get the exact figures, but let's just regardless rely on this number as foreign and international investors that own US debt. Okay, so now let's take it to this big chart. This is the one I said I would update yesterday. This is the entire history of the United States federal debt from its founding, central bank versus foreign holdings. Okay, I don't have the foreigners on here yet. It's less deep, but a couple points I wanted to make here. This is basically pre-Federal Reserve. Okay, pre-Federal Reserve. And just a few points. Like, I'm not a fan of war. I'm not a fan of monopolistic entities like a central bank obscuring the value of the dollar and buying too much debt outside of what the public can or should do or would want to do. Okay. But first of all, a few arguments. As I've always said, even here, let's take this off. Even here, in the founding of the Republic, after all the constitutional conventions, 1789, we had 70 million in public debt. Most was owed to the French, Spanish, and Dutch. So, as I said on Peter's show, there's nothing more American than getting help in your revolution from the French. And I'll continue to say that for people that think that somehow the U.S. has no right supporting Ukraine, or Ukraine needs to fight this just barbarous Russian invasion by themselves. It didn't happen for the United States. It was not corn-fed patriots that were doing it alone. There was a lot of European Africans that were helping, that came to America to help fight. There were a lot of Poles. And as I mentioned on Peter's show, and I mentioned it here as well on a stream maybe 2 weeks ago, you even had Kazimir Pulaski, who was the founder of American Cavalry, brought the American Cavalry together, from the ragtag militias that Washington had started. This guy was a Pole, and they discovered, again, I'm not a DEI person. People should be happy. People should be free. But this guy his bones went around and interred at different places. He died in Georgia in the Battle of Savannah. And eventually the Smithsonian started looking at his bones. They checked his bones with the DNA of his ancestors. It matched. It's possible that this guy, Pulaski, was an intersex person, or he had characteristics that were more female than male. All right. So again, how much could the Trump administration explode when you're rewriting websites and trying to rewrite history, when the father of American cavalry perhaps was, well, for sure he was a Pole, he wasn't American, he was a Polish person, Polish war hero, maybe even a woman. That's the kind of contrarian information you're going to get on this channel, guys. All right, so First Bank of the United States failed, good. Andrew Jackson took down the Second National Bank of the United States. Or sorry, he extinguished the debt, and then the Second Bank of the United States lasted for. No, he took down the Second Bank. I'm sorry. Of course he did. He took down the Second Bank of the United States. Okay, and at this time, it's interesting. Look, they only had 20-year charters. All right, 20-year charters for these central banks. Hamilton, of course, was a proponent of the central bank. Jefferson was not. Jefferson was correct. Hamilton was not. And, it's not good to have a centralized It's better to have the markets, like happened in Canada and Scotland. It's better to have the markets pricing your debt. Then we had the Civil War. United States raised a ton of debt without a central bank, but Lincoln did require that banks buy government bonds. So that's a very central banking like activity. So basically, Lincoln just required it. The National Banking Act. So there was a lot of bonds that were basically forced on banks. But then we had huge growth after the Civil War, and we had debt that was going down. Again, contrary to what you think. We don't necessarily need rising debt to have growth. Interesting. Did go up here before the Civil War. But then again, here's another contrarian thing. If you follow the old Misesian's maybe not the best word here, Rothbardian, very hard right people of the Mises Institute, which has some great pieces of literature to read for free. It's good stuff. But they sort of embellish a lot of things that actually happen. They say that because of central banking, we could have these two world wars. Like because of the United States central bank, again, Europe went crazy and Hitler went Nazi. It's always blaming the United States. That's a key hallmark of the Mises Institute. That is just obviously a fallacy. I'm going to show you how much of a fallacy it was. Here's the end of World War II, and this is just the U.S., right? United States debt. When the U.S. entered the war, it raised debt. Nations always raise debt during war, okay? They don't have enough resources to pay, so they borrow. They borrow from the future to pay for the war. They did it in World War I, and they did it in World War II, okay? Each time they entered, which wasn't even at the beginning of the war, right? World War II started September 1939. World War I, July 1914, June, July 1914. The United States entered late both times, okay? The United States did not cause the Nazis to be Nazi, right? Regardless of what anybody says. And also, here's the kicker. The central bank did not monetize this debt. How can I prove that to you? Because I have the data. I'm going to put the Federal Reserve. Federal Reserve opened their doors in 1914. I'm going to put the data of Federal Reserve holdings of U.S. government debt right here. All right. They definitely monetized some of it. When I say they, I mean the Treasury. All right. You printed money to raise debt. It was far and away the minority. Not much. Not much. All right. Let's look at this as a percentage. Key thing is World War I. World War II, yes. And Great Depression, yes. A lot of stuff, historically higher, let's say, 10 times higher. But World War I, Woodrow Wilson, the evil guy that everybody thinks has just caused Hitler to become Nazi, even though it was the French that wanted the reparations on Germany, 1%. The Federal Reserve monetized 1 to 2% of United States federal debt in World War I. Okay, a war that was started by Germans and Austrians was not started by America. I know everybody loves to hate America. It takes a Latvian living in Europe to apparently speak well about America these days on center-right sort of shows. Contrary to what the Mises Institute will tell you, the Federal Reserve of the United States did not cause Hitler to be Hitler. He did not cause Germany to go crazy. The Federal Reserve and Woodrow Wilson himself, he did not. Contrary to them, the Federal Reserve is a very small component in monetizing the United States debt of World War I. And World War II wasn't that big either. Sure, it was 10 times bigger. At the time, you could say that was a sea change. But look at the total debt. We get up to 10%, roughly. 9, more like 9. More like 9%. A Federal Reserve printing of U.S. federal debt to fund the war. We see Roosevelt going crazy here in the Great Depression, obviously as a percentage of the debt at the time he got the Federal Reserve to print a lot here. Some craziness with the Gold Reserve Act, of course. These were, there's a great book. I'm going to need to look it up right now, by an Argentine economist who talks about this period. And it's highly reminiscent of today. We have all these deportations without due process, people taken away from their families here in the United States. Again, however you feel about immigration, we're bending the law. We're testing the levels of the Constitution in the United States today, in 2025. We basically suffered a constitutional crisis with gold here in the Gold Reserve Act. Roosevelt got gold to be illegal, had people turn in their gold, although most didn't turn in their gold. But he got gold to be illegal, basically ruining people's property rights for gold. And he got the Supreme Court to rule in a very split decision, which they actually gave 3 opinions. It's a fascinating topic. To basically say that bondholders of U.S. debt didn't have to get paid at the pre-peg price of gold being worth, basically a dollar being 1/20th an ounce of gold, or $20 per ounce, but $35 per ounce once Roosevelt devalued it. And basically what that does, as far as the bondholders' perspective, it devalues them by that increase. And the Supreme Court bended to Roosevelt here. So Constitution has been tested many times. Roosevelt is far from perfect, as we know. His body was basically, the body was not even cold, and Congress put in, which amendment, remind me, for 2-term presidents. I should know that now that it's being tested right now. Body wasn't even cold, and Congress passed the constitutional amendment that basically restrict the presidency to 2 terms. All right, Roosevelt's far from perfect. But again, if you get the view that it's just the United States, it's just horrible with everything, you're going to miss some of the horrors that exist in the rest of the world, which I wish people would pay attention to for Russia. Anyway, that's my little rant on the Great Depression and World War I, World War II. The Federal Reserve had very little to do with it. Certainly during World War I, also during World War II compared to today. But this was a big jump. This was a big jump during World War II compared to World War I, for sure, 10%. All right, now let's take this off. Let's resume it, and we can see the crazy exponential growth of debt since then. So I've talked about this many times. I'm not going to go through the whole thing. Let's start from, say, Vietnam War. When the Vietnam War ends till today, let's zoom in. All right, holdings of central banks still seem kind of small, but here we can't really see because of the tooltip. Let me zoom in, actually. Seems like a decent percentage there. Too much zooming in and out. I know I hear people say that I zoom in and out too much. All right, let's look at this. I'm going to have to zoom in. I think about this now, and I'm going to have to zoom in before today. One more sort of historical episode. Let's look at the holdings of the central bank now as the Vietnam War ended until the global financial crisis. Okay, this was a top at the time. All right, remember I told you in World War II, we got up to 9%. That is the Federal Reserve monetizing United States government debt. Here we get up to a local top of 18%. Right as the Vietnam War ended, we got up to 18% central bank versus total United States debt. Okay? It ended up going down, but it didn't necessarily go down for a good reason here. Okay, so now we're on a pure dollar standard. So debt is really rising more than the Fed is printing. That's what's happening. But you can, in some ways, say that's better, but they're both going up, which is, of course, not a good thing, but this is how exponential growth works. To where we kind of bottom here somewhere at 7% only. But of course, that's the debt rising. But then people realize in Congress, the split Congress, Gingrich and all them with Clinton, that we got to sort of balance the budget. That was a great discussion in the 90s. Could you imagine? They did balance the budget. And what a balanced budget means is the debt doesn't increase. The debt is simply, that is the light shaded green area, is simply an accumulation of deficits. When the government spends more than it taxes, that increases the debt. That's how it works in fiscal policy. So when you can see this sort of cresting, not increasing anymore, national debt, that means that it's a balanced budget. But it's only a balanced budget for 1 year. Actually, there was a couple years, but I'm saying you have to balance the budget every year to not have the debt keep growing. So they did do it a couple years at the end of Clinton's second term. You do see there's a little bit more printing, though, just a little bit to make up for it. And then, of course, 9/11, Bush wars, and we go off to the races again. Terrible. Absolutely terrible. I wouldn't support this. Many people didn't support this with their votes, but this was a time of hysteria, and we increased it again. Then we go to the global financial crisis. You see this like sort of actually drop. I've talked about this a lot, but I'm going to zoom it out and take this off again just to give you the absolute craziness from today. All right, I talked about this before. This is really the big picture as far as the strength of the dollar and how much the Federal Reserve is willing to print to cover the debt. All right, so I'm going to put the holdings of the central bank back on there. Now we get up to really sort of seemingly nosebleed territories. The percentage goes down here because during the global financial crisis, we had a lot of these bailout packages, the TARP, the TALF, and the Federal they decided the best thing to do at the time was have the Federal Reserve basically pay for those things. So the Federal Reserve actually sold treasuries, all right, gave safe haven treasuries to banks and swapped out with corporate debt. So this was the Federal Reserve sort of working out. They didn't really know what they're going to do at this point, and it went back to the companies with, more guarantees. So they actually took the corporate debt did go back into the economy, but with just more guarantees from the government. That's going to increase the confidence in that corporate debt. So this little drop here from 9% to 5% during the actual global financial crisis is the bailout of Main Street by the Federal Reserve. This is the Federal Reserve taking a lot of corporate debt on instead of U.S. federal debt. But then they swapped it right back. And we had QE 1, 2, and 3. This is the Federal Reserve buying mortgage-backed securities primarily, which were those garbage junk bonds, as we know, with bankrupt people with 5 houses. And this was all put into a computer algorithm that Blythe Masters was one of the pioneers of, and they said it was AAA security. Of course, it's not. And this debt still exists to this day. If you look at the balance sheets of Fannie and Freddie, you'll still see like trillions of dollars. Absolute zombie debt. Okay, but that was saving the economy, as they said. Okay, so again, clearly not normal central bank activities. If you want to, I'm not saying the central bank is a good thing, but not normal. What do we get to here after QE3? We get to 23.5%. 23.5% of U.S. federal debt. And they finally taper it out. And I want to remind people, as I've said, Bitcoin is not always an inflationary asset, okay? Because if we say inflation in the classical term of money printing, we did not money print. The Fed did not money print from 2014. It did not. Look at forget the holding percentage, look at the numbers. This is the printing press, basically. It's actually the holdings of treasuries, but it's almost the same thing as the monetary base at this point. 4.1 trillion in June 2014. Where is it in September 2018? 3.9 trillion. It's going down. It's flat and then going down. The Federal Reserve's. This is the printing press. Okay, so contrary to what Bitcoiners were saying during this time, and I was around, everyone was always saying all the central bank knows how to do is print. This actually, they were not doing that. So you're not correct to say that Bitcoin is always an inflationary play because Bitcoin was rising in value here. Yeah, it did actually go down. This coincided with the crypto winter after the 2013 top, but it was rising right here. Bitcoin was rising as money printing was flat or going down. Important point to keep in mind for Bitcoin. But at the end of the day, it is true that, and I would fully support if someone said that a solution to any crisis, the main tool and the only tool that central banks know how to do is print. Of course, they did that for COVID. But again, one thing to point out, just before the spike in February 2020, which lockdown started February 2020, notice this is the repo crisis, and this is just every market's getting antsy and the Federal Reserve having to buy more debt. Look at the percentages increasing. Okay, we go up from 15. We bottomed out at 15.7% Federal Reserve ownership of U.S. Treasuries. Before COVID, they were already at 16.4. Now, of course, there was news about COVID all during this time. It was scary, whatever. But the economy was not healthy regardless. COVID masked that, pun intended, I guess. It masked those underlying problems in the economy, and we had a whole new structure and set of problems to deal with during COVID. But the economy was also not healthy here, which is why they had to start printing again. And here, actually, Bitcoin did line up. So this is the whole picture. Look at that. That's 200 and nearly 250 years of U.S. debt policy and U.S. monetary policy, all in one chart. Zoom in again to the present. COVID, and then we have the top out is almost 30%. This is the number that I kept mentioning in the last couple days, is the Fed has almost held as much as 30% of United States government bonds. Now it's down to 18% as the Fed does try to shrink their balance sheet. You can clearly see with your eyes that we're bottoming out in this figure. And obviously, uncertainty is rising. Look at any volatility index. This is going to go back up. Whether this is a sharp rise like this, I don't know. But this is Bessent's. It all comes down to this. This is Bessent's worst nightmare, is the fact if these foreigners, Japan, China, UK, we might have some leverage over. But Japan and China, Japan is ready to do anything to defend its national security. That's the foremost thing that Japan's worried about, along with Taiwan, of course, but Japan is worried. And the United States has been the guarantor of that for 80 years. So if it is Japan that's playing ball and saying, look, we're going to sell, then the United States has to listen. Having said all that, again, this is why I try to stay away from the platitudes and just show you the data. We have room to print here, don't we? I'm not saying it's a good thing to print. I'm not saying that Bitcoin won't go up if we don't print. And by the way, we coincided here. So as I told you, Bitcoin is not necessarily an inflationary asset. Inflation was going down. Monetary inflation was going down here from 2014 to 2019. Bitcoin went up once, but then it did coincide in 2021 because of, in my opinion, that's more a meme coin effect than the exact money printing effect. We'll talk about that more in a second. This is more macro, real world. Bitcoin is still small and being adopted. That's the key, all right? So it's not necessarily counter-cyclical or cyclical with inflation. That's what I'm trying to say here. And, we may go back to printing. We may now go back to printing. We've clearly been, the Jackson Hole speech came here. Powell was ready to be the hero. Taper the balance sheet off. Raise those interest rates to 5%, which were levels that really we haven't seen, in a long time. Let's go back and show you here. Here's the 10-year in black. All right. Let's just see. I'm actually curious myself. I don't know. In October 2023, it was nearly 5% 10-year. You'd have to go back. to 2007, so pre-crisis levels. And as we talked about yesterday, I think that the bond market now is done as far as the long-term trend. I mean, they can try to push them down to zero again, but that's not going to work forever. You can't just keep going to 5% and then going back down to zero. I shouldn't say that. Again, I don't want to do too many platitudes. They could try, but I think the world is waking up to that game. Okay, so that's the Federal Reserve. Now this is going to be a loaded chart now. We're not at a top. We could clearly go back to 30%. Fed has plenty of room to monetize if they wanted to monetize, if they needed to monetize, and if Besant, even though Powell is supposed to be independent member of the monetary structure of the United States, Besant could say, look, our tariff policies are screwing us. Foreigners are selling our bonds. We need you to buy. Of course, they have those discussions, even though they say they don't. We have room. We're only at 18%. We have room to go to 30%. And, who's to say how high it can go? And by the way, hyperinflationary economies, this number turns into 100%. Okay? That's what happens. When there is nothing, when there is no one left to buy your fiscal craziness, and the only entity left to buy that is a central bank, then this number rises to 100%. So that's what a hyperinflationary economy is. This is another way of looking at a hyperinflationary economy. So we're not there. And we're probably at some point soon this mound is going to increase again instead of going down. Okay, now, I started the show talking about the mysterious foreign holders of United States debt. Let's layer them onto this chart as well. Okay? To make this even easier, I'm going to take off the dollar holdings. Okay, so just now you have the percentage. You understand what it is. It's the percentage of the Federal Reserve's ownership. I'm taking off the dollar amount, which is here. Okay, here's the percentage. Now I'm just going to show the percentage of foreigners that also hold U.S. debt. That $8.5 trillion. Or I guess 8.5 trillion. Okay, ready? There it is. Not necessarily a pattern either, other than growing from 1970. But let's go ahead and zoom in. This is as long as I have the data, right? Foreigners used to hold 3.5% of U.S. government bonds. They topped out at 34%. And to sort of show the most vulnerable / manipulated, I guess you could add these two percentages. Okay, so at this point in 2014, which is interesting, actually, it's not COVID. Well, we're going to do COVID in a second, but at this point in 2014, you were at 57.5% central bank and foreigners that owned treasuries. So the domestic consumption of treasury bonds was almost only 40%, 60-40. You don't want that in a stable market. In a stable market, you want your private individuals, pension funds, hedge funds, 401ks to own safe assets. Not the central bank and not foreigners. In some way. I'm not saying foreigners are as bad, clearly. But also another thing to point out is central banks are a huge component of that. Let's try to break that down. We got to go back to, not that one, we got to go back to this one. Okay, so this is Treasury plus agency plus agency. These three things are total U.S. Treasury securities that are government securities. Okay, we add them up. Remember, this is of June. We're at 8.5 or 8.4, whatever it was. 7.1 plus 1.3, 8.45. The actual number is, oops. No, I gotta go to this one, sorry. Yeah, 8.5 trillion. Okay. And they even miscount. All right. If you really want to be nitty gritty, they miscount their totals. Okay. At different times. Here, they say foreign official institutions, that means central banks, hold little over 4 trillion of the 8.5. So half of this black line, I guess I could, this data is harder to find. I wish I could have a separate line here for you, but half of this black line is foreign central banks. So you get in this kind of, what's the least way to say this? Circular referencing type of scenario where foreign central banks are printing money, and with that printing money, they're buying U.S. government bonds, and that is about 15% of the total, whereas foreign pension funds are another 15% of the total. So anyway, point is, the Fed and foreigners, nearly 60% here. Now let's look at COVID and add these two percentages together. A little bit less than nearly 60. We're at 54%, adding these two figures. But it's been going down in general since 2014. And the Fed hasn't always been, picking up that slack. Here was I'd say a very good trend, frankly. Of course, you want foreigners to buy your debt if you're sitting in the administration, but generally you just want, you don't want too much debt, and if you're a local society, it might be good to hold it yourself. Both are going down here, leading up to that repo spike in 2019, which was here. And then COVID just blew it all out, and the Federal Reserve intervened. So as of March, and the foreign number I haven't updated since December, right? Don't have the data, but as of March 2025, it's 40% total is Fed and foreigners. So now we're in this just sort of wild poker game where people want the rules of the game to change. People want certain actors to buy more debt. People want to warn about if certain actors hold too much debt, i.e. the Fed, because too much debt held by the Fed will definitely lead to a rise in prices. And we are trying to cut the government, which is good. All right, even though a lot of people, at least on the left, don't like the way the Doge is acting. It's a popular thing across the spectrum in the United States, and I think generally, to cut the debt. So a lot of cross currents happening. But the one thing that Besant does not want to see is that rise in yield as the market generally falls down. Okay, so from this point, it's bad. From April 2nd, 2025, all right, that might be the, and that was Liberation Day, of course. So from Liberation Day, I wonder if we'll look back and say, that's like, that actually is the day where the U.S. lost its supremacy in money. That would be interesting because yields are going up while the market is flat to down. It's too early to tell. All right, I am not a hysterical market commentator. At least I try not to be. So it's too early to tell. But that's where we are. Okay. I wanted to look at the S&P now just to show you the general trend. And again, why that's different from Bitcoin. But a couple things about these trend lines as well. I think this is interesting looking at the S&P. So this is only going back to 1950. You can find the stock market going back to the 1800s as well, both the Dow and people have reverse engineered the S&P as well, but this is still the beginning of the S&P traditionally around 1950. The black line is the all-time trend, all-time starting 1950. Okay, it's about 7% per year compounded, 7% per year compounded, roughly. If you're now, the red bands are the wide ranges, right? Those 2 sigma, like really most of the deviations will occur in here. And you can see that even an exponential trend can change over time. Okay, and so we can see that very clearly here. So as the red bands are above the black line here in the 50s and 60s, the United States economy or stock market was growing faster than 7%, okay, because it was above this number. Here it went below, all right? And then interestingly, if I pull it here, and this just shows you the risks of trendline analysis, look at where, let me take the black line off because the black line is all time. All right, moving until today, but we didn't have all of today's data at the time. We had only this data, and this is an evolving data. So look at where the stock market was in the 80s and 90s. It was bumping up against that 2 sigma move always. You might have thought we were overheated, like time to sell all your stocks. But of course, the World Wide Web started in 95. The internet was before that, but the World Wide Web, 95. And then you can see what happens from 95 on. So let's zoom in more like here. We were right here, right? And of course, moving up to the dot-com boom, we made all new highs, tripling the value from 95. If you are a right-wing libertarian, I can guarantee you, not guarantee you, but I can assure you that there were plenty of doom and gloom newsletters to be reading right during this time, saying the whole world's going to collapse. Went to new highs. And then, of course, big drop again, 2008. It can be Maalox moments, and the adjustments can take decades. And I'm not saying government intervention isn't influencing stuff here. It absolutely is, 100%. But even with the fall here, this is a monthly frequency, so I only got it from, oh, shoot, I didn't update that. My bad. What's the number of the S&P now? It's, sorry, let me check. 5.8. It's down to 5.2. Okay, it's not going to be much lower. Let's go back to 5.2. It's here. We're back to June 2024 levels. Point is, from December here is the picture. We're still way at like high levels. So we definitely do have room to fall. We're not even at the trend. We're not even close to the trend. The trend as of April 2025 is 4.2. We're at 5.2. And by the way, all the traders and stuff, they're using way different trend lines than me. Like, obviously, if you started the trend from 2009, you get a way steeper trend line. You get something that's like 12% compounded black line. This is only 7 because I'm going all the way back to 1950. So it's just a point of sort of interest, maybe, if you want to look at these trend lines and follow the differences, I think, because I'm always trying to be a big picture macro guy here, not freak out too much. It could absolutely go back to the trend. It could go under trend, 100%. And that's why something like Bitcoin is better. At least right now, we're lucky to have Bitcoin right now, because here's the same chart now with Bitcoin. Okay, I'm taking the evolving trend line off, and I'm just have the same. It's the same type of thing. But here we can see, obviously, Bitcoin is clearly not an exponential growing asset. This is an exponential growing asset, like all things in the world. It's a straight line on log scale. Even if it's up and down, according to the red lines, you draw a straight line through it. This is a 97% R squared, by the way. exponential trend. Stock market is an exponential thing. Stock market is going to recover if it crashes. We're not going to go back to Mesopotamia, no matter what newsletter writer wants you to go back to Mesopotamia or thinks you're going to go back to Mesopotamia and you should pay him $9.99 a month for his newsletter. By the way, my BTC Pay server is open for donations, please. But I'm never going to do a newsletter like that because I think it's a grift that tries to scare people more than lets them enjoy their lives. So if you like that message, please stick around. Thank you. So here's Bitcoin. It's not an exponential asset. Bitcoin is a network being adopted. It's a power asset. It's power. The curve grows faster at the beginning, slower at the end, but it's still to this day a huge growth rate. 45% per year, about 42% per year by the end of the year. It's not going to reach 10% compound growth for another 100 years. And we're right on trend. Okay, so again, Bitcoin could fall back to the red line, but the red line is a deep, that's a deep drop. We haven't even hit that, since like way early days. And here, the difference here is this is the all-time is the black line, the evolving. I can show you how it sort of evolves in the middle. This is how the power trend changes. It was a faster growth rate here, slowed down. But if you want to try to blend it and look at it through all time, you have to look at this solid black line. And as I've always said, from 2016, it looks pretty beautiful. The deviating or the evolving trend line, the dotted black line, barely, it gets pulled up here during the 2017 and 2021 booms. But by and large, look at that actual versus projected. Here's the beautiful, simply mathematical projection. Here's actual. It's pretty good. Like really good. Statistically, this is awesome. It even looks nicer than the S&P. Okay, S&P looks good from 1995. But that took a lot of time to get there. And if you're thinking, well, maybe Bitcoin like we're in this section and we would depress down to this section with Bitcoin, yeah, we could. I'm not saying that, but so far it's a beautifully looking power curve, and that's all I can show you, or models, and we try to base decisions off that. I think that's all I had for the immediate presentation. So let me know, guys. No comments yet. If you want to interact. I had a commodity chart handy on TradingView, so we have this change in commodities in the last year. Obviously, gold and silver up. In 5 years, gold and silver up. Brent down, which is very good. This is very good geopolitically. This is the best thing about the geopolitical turmoil right now. Is it's great for consumers driving cars, but it's also great for Eastern Europe being protected from Russia's war machine, which is 30% funded by oil and gas. At least 30% funded, probably more. I think that's the official budget percentage of the Russian Federation is 30% oil and gas. I should do a presentation on that and get the exact numbers. This is just wild, though. So it was rumored that it was Japan, largest holder, threatening basically to sell more. And that would drop the price of bonds, raise the yield, make it harder on everybody else to pay interest payments, and squeeze, perhaps, be a squeeze on the dollar. Here's another interesting thing I noticed. Cayman has a huge amount of private. Oh, I think I saw a chart that was stocks and bonds, but here's the Cayman Islands official, 300 billion. Obviously, as we know, Caymans and all these offshore Caribbean polities are great for Great for opaque investing. 300 billion from the government itself. But let's go down. Yeah, 700 billion if you include Cayman Island investment in corporate bonds. That's a huge number. It matches Canada. It's unbelievable. And if I had the table, which I don't have ready, of showing equity investments from foreign investors, would be even higher. I like trillions higher, I believe. So, yeah, a good thing to do. And I don't know how. It's lovely. They talk about like how this is going to be expired, but it would be really good to compile this in a chart with the main countries over time plus stocks. That would be a good chart to show, I think. Foreign influence on U.S. stock markets. This is just bonds, corporate and government. 13 trillion, 8.5 is the government. And they can't even count that completely right. Still early in the stream, guys. Let me know if you have any, if you want me to show any other charts or look at this again. But this is a big part of the picture. Numbers can tell you a lot, right? I really do mean it when I say things like all the doom and gloomers blaming central banking on everything. Central banks are not a good thing. I'm not a fan of central banks, but to say that, again, Woodrow Wilson made the Nazis Nazi and the Federal Reserve made the Nazis Nazi, they weren't even involved. They just were getting their feet wet of their monopolistic enterprise during World War I. They were not involved. It had nothing to do with reparations, nothing to do with anything. That was the French that wanted the reparations on the Germans. But from World War II, it is true. We can see we're off to the races of the dollar hegemony. All right, Bretton Woods Conference right here. Most of the gold is now in the United States. It's going to be swapped for dollars. The world becomes dollarized from this point, basically, from Bretton Woods. And we have at least 8% central bank monetization of the debt. Another reason I like this chart is these are balances. These are not flows. These are stocks. Okay, and when I say stock, it doesn't mean equity. It means a balance, a balance of the value. And that can show you the cumulative effect much easier. Of course, balances can change quickly, like it happened here after the gold was confiscated and all the New Deal programs. It's interesting that the Fed monetized some of it, but then actually got rid of it until World War II. If anybody knows the reason why I don't know why. It's clear that it was the New Deal programs and the confiscation of gold, how the Federal Reserve took a lot of debt, but I am surprised that they sold it almost to basically to World War II, back to 3%. It's an interesting dip. So it can happen quickly, and certainly it's more volatile. Another lesson from this chart is we can see that the central bank is more involved in the management of federal debt. How do I know that? Because it's smooth. You can see how smooth these lines are, right? This is when they start saying things like we're buying 80 billion a week. We're buying 80 billion a week or 80 billion a day, whatever it was at certain times, right? It was a week. But if you go back to here, like Vietnam, at least there's a semblance of a marketplace where you have more jaggedy, up and down changes in the balances. Okay, let's take off holdings of foreigners, but at least, because this is a quarterly number, by the way. That's why it looks smoother. But this is this is monthly, and even though of course it's a general smooth up and down or trajectory up and down, at least you can see it's jaggedy here. But once we get to Ben Bernanke having to clean up Greenspan's mess, it just becomes smooth. And that was by design. He wanted it to be predictable. Wanted it to be predictable how much debt the Federal Reserve was buying or selling. I can assure you that neither Bessent nor Powell want this number to rise, especially during this climate. Now, Donald Trump wants lower interest rates always, so it will have to rise if he wants that. It will have to rise, especially if the debt falls, by the way. If they cut spending, but Donald Trump still wants interest rates lower, then this will rise quickly. But they do not want this number to rise. Bessent and Powell both can say it has room to rise up to 28%, 30%, at least by precedent. But these were like hysterical times. This was one of the most hysterical times in like the modern world. Getting up to 28%. Never say never. They would imagine, they would like, that is the central bank, Powell, that this just sort of smooths out, right, and goes back to a sort of manageable level. Let me know if you think that will happen, if it will be a manageable level in the future. Whereas pre-GFC, that level was 9%, okay? That was another interesting thing to say, right? That's the Bretton Woods level. Yes, it did max out here by the closing down of the gold standard and the ending of the Vietnam War in 1975. It maxed out at 18%. But from Bretton Woods, had this little dip here. I don't know what it is, but let me know. Maybe it's something to do with the Marshall Plan. I don't know how that could even be the case, but because it's just central bank ownership of debt. Oops, great. Go back here. That's too much blank screen. See all my charts here that I have not organized so well, but to keep the train of thought going once this loads. Bretton Woods levels of debt held by the Fed is 8%. Okay. It's possible that the Fed took less debt here to allow other foreign governments at the time to take more. I don't know why that little weird dip is, but yeah, point is, yes, it did top out at 15, but generally during the 50s and the 60s and during the 80s and the 90s, you were somewhere around 8 to 9% of Federal Reserve ownership of the debt. And this is, again, another way of looking at the printing press. This is what it means when they say the central bank prints money. And a hyperinflationary economy would eventually get to 100% central bank ownership of government debt. Okay, hey, RV, he says, if the holdings in the central bank were decreasing from 2021, who bought them? Yes, correct. The market, banks, the market. Foreign holdings, as we see here, went up a little bit. Okay, so now we have the foreign holding percentage. Let me take off the that. So you just, simple here, just percentages of each. So holdings of central bank went down. Holdings of foreigners actually kind of stayed flat, also down. So this was made up. This gap was filled by pension funds, hedge funds, just domestic U.S. investors. And this thing right here, again, the dollar value that the central bank holds, it literally is the printing press. Whether physical, whether digital. Okay, the physical portion is only about 2 trillion of this, 2 trillion. The digital portion, which is actually a little bit more than the reserves. Reserves are, because they have this reverse repo, which is for non-banks, but don't worry about that. It's a big number, but this is the total of how much treasuries they buy. The actual act, the mechanics of this is as simple as a keystroke. It is a print. There's nothing else. Don't let people confuse you or say things like they lend it into existence. That's not actually true at all. They buy it into existence. They print the money and they buy. And they don't have to buy treasuries, by the way. They do buy treasuries. That's typically what governments do. The sovereign, this is why printing money was even invented. The sovereign, which wanted to invade people and steal things and whatever, they wanted, a buffer there. So the sovereign had the bank start monetizing more. That's all there is. But the sovereign doesn't have to be the one that is the beneficiary, so to speak. The beneficiary could be gold miners. It's possible that the Federal Reserve could print money and buy gold. It's possible the Federal Reserve can print money and buy Bitcoin. It's possible the Federal Reserve can print money and buy real estate. And they actually did do that here. A huge chunk of this value is actually bad real estate. I mean, it's the worst real estate investment you could possibly make, but that's what they did. You got trillions here. I'm looking at the dark green now. Let's take out the debt. There's trillions of dollars here of bad real estate, whereas they only had in total government bonds under $1 trillion, not even 800 billion before the financial crisis. They can buy whatever they want. There's no rule. There are rules, but they can still break them. They can buy whatever they want. They didn't loan it to someone. No, this is just a printed. It's a from nothing, ex nihilo. It's ex nihilo. It is from nothing, printed. That's how it works. So whether it's paper, and the way they do that is the Federal Reserve banks, they print the paper. Actually, the Bureau of Engraving does it, and they give it to the Fed. Some weird transactions there, but the Bureau of Engraving sets it together with the Fed. The Fed sends it to the central banks around the country. The same process would happen in any central bank in any country. And those central bank branches literally send pallets of those dollars to banks. And when the banks receive the pallet of money, the banks receive from the Fed the money, and the banks give the Fed U.S. Treasury securities. That's how it works. That's in paper form. And in digital form, it's the same. It's quicker. In digital form, the Fed credits the bank a bank reserve balance, which is now the core money. It's like the core checking account of the bank. And the bank gives the Fed U.S. Treasury securities. And what you see here is a chart of U.S. Treasury securities. And those U.S. Treasury securities are a proportion of the federal debt, which is there. So that's it. This is the mechanics of money. And you won't find this chart anywhere, by the way, because, I shouldn't say it like so self-aggrandizing, but the Federal Reserve only has digital documents back to here, 2002, which is hilarious. All the digital downloads from the Federal Reserve only go back to 2002. And prior to that, There, you can either find them from the paper bulletins or this Mr. Barnett, former Federal Reserve economist, founded the Center for Financial Stability. They have a worksheet you can download, and they have a weekly Federal Reserve balance sheet that they themselves did. You have to go through it and sort of classify things yourself. They also make classifications, but they have it all the way back to 1914. So that's where I get the rest. But I really think this is interesting, and it just crushes the narrative of people that central. I'm not here to defend central banking, but it's get your history right. Okay, it's not that central banking is the scourge of everything. You still had wars without the central bank. So, this is a very important chart to show that World War I was done by the American. I mean, the entrance into World War I was, of course, happened at the behest of the government, but the Department of War at the time, which it was called, the war bonds, they were raised from local domestic American companies and individuals. It was not from the central bank. Roosevelt did a lot of damage. He also did a lot of good things as far as saving Europe. But as I said, the body was not even cold where he died, I guess, here just before the end of the war. And they put a two-term constitutional amendment on the Constitution. And then there's your American history pre-Fed. It was only here, by the way, that the gold standard was enacted in the United States. Before here, it was silver. It was the currency of choice of the government. Currency is the wrong word. It was the money of choice of the government was silver. From here, it was gold, and most central banks around the world went to gold by this time, late 1800s. It was very short-lived. The classical gold standard basically only lasted here. I don't have much on this chart showing other than U.S. debt, but you would have central banks around the world, governments around the world, settling their international payments in gold, only for a period of 50 years, less. I hasten to say again, we remain very lucky with Bitcoin because here, say, a lot of the hard right libertarians, right, who were, before the web was really taking off and newsletters were sent digitally, you'd have to have mailed out newsletters, and the Ron Paul report was one. And of course, we had some unfortunate remarks from people that still to this day don't support Ukraine, like Lou Rockwell. Some very racist newsletters were coming out in the name of Ron Paul, authored mostly by Rockwell, in the 80s and the 90s. And how do I really say this to... There's a lot of grift. There's a lot of grift out there. People that aren't really looking at the numbers, don't really understand the situation. People that were really frustrated that the gold standard ended, but then thought that the world was going to end right there, all in the 70s and the 80s. This turned out to actually be if we layered the stock market here, this turned out to be, one of the boom periods, right? It came out from the high interest rate periods were here, okay? Sorry. Let's go. This is a better chart. Let's go here. This was precisely when when it turned around, was at 20% interest rates, 15 on the 10-year, and the stock market took off. And even this huge crash in Black Monday in 87 was like minuscule, really. Yeah, people lost money. If you're margined, if you borrow money, you're going to be margin called. You're going to lose your money. But if you stick around, the trend is your friend. And I really do mean it when I'm trying to bring in these stories of people who I know don't respect Eastern Europeans for whatever reason. A lot of them have hard right, some even could say some Nazi tendencies. And they send out these newsletters that really are just grifting. The world's going to keep going on. And even as it is crazy, I am the first to admit this is not, like, for as crazy as this mound looked like in 1975, all right, in an analog world of slow-moving money, and I can see a lot of newsletter writers would want to go crazy here. I mean, you can tell you can talk about social stories here. It's just like it's fodder for Tucker Carlson and all these people that just sort of tangentially hear something. Tucker Carlson, by the way, is defending these protection of tariff policies. There's a lot of hysteria. There's been a lot of hysteria these days and a lot of growth of newsletter writers that capitalize off the hysteria. Again, I'm not one of them. And I will never be. I pledge to you that I am thankful that we have Bitcoin that you can donate if you like the work, but it's interesting. There's a lot of greed, a lot of fear. And we got Bitcoin here that just stays on this trend. And, how many times do we hear Bitcoin was dead during even just this period? 2017 going to 2019 is puking from 6 to 3 in price. Let's think of that and that. I remember that day. It's a couple days here, but I remember the big one. I was on a plane coming from Europe to the U.S. Just many times Bitcoin was declared dead here. My favorite is Peter Zeihan, somewhere here, on Joe Rogan. The perennially confident Peter Zeihan, who I actually do agree with a lot of his geopolitical policies in support of Ukraine, but doesn't understand anything about the Bitcoin system, says that Bitcoin is $17,000 overvalued at the time that Bitcoin is $16,000 on Joe Rogan. Of course, that was the bottom. Of course, it was the bottom. Peter Zeihan, by the way, has a newsletter. What are you referring to? RV writes, I'll put it on the screen, this one. A bit off topic. Does anyone know how it ended? Quote, it means that the Treasury Department and other federal agencies of the U.S. government will disclose their digital asset holdings. Yeah. I don't know how it ended. I don't know when that is coming. But I can pull it up for you. Let me just take this camera off while I change it. Let's go to our friend Rodolfo Novak from Bitcoin Treasuries. This is a great site, and I need to improve this myself, my own site to really be like this. But I have so many different charts, and they're in so many different ways that I sort of can't. But I'm going to put his site on now. There we go. I guess I should take myself off even. You don't need to see my ugly mug for this one. So here we have ETFs and private funds, public companies, and governments. Governments are the orange. Okay. And this is a great site. So this will just show you, of course. Where's a good? Here we go. This is 174 entities. That's interesting. And then from the value, we can see ETFs. Obviously, this is the amazing thing, and this has been better than this is better than gold ever happened. Like this growth, basically, is from here. When Gensler finally capitulated, you only had like some ETFs in Europe, and then it just explosion. BlackRock now has more than Grayscale ever had. 1.3 million BTC, public companies, of which Sailor is like 4/5 of. Here we go. There it is. 528,000 as of late. All right, so that's 5/7 of. And then governments. I love this about Bitcoin. I love it. I mean, that's that's going to grow, and the price will grow from it. But I'm not, I don't care one way or another, frankly, if governments do get in, but they will. We know that they will. RV says it should have happened by April 5th. Yeah, I'm sure it's there, and we can get more detail, but I bet Rodolfo himself is even picking it up. Great company to secure your Bitcoin right there. CoinKite. Wonderful company. I used to have a deal with them. Maybe I'll renew it, actually. I stopped it for about a bit, but great company. And this is a great site just to show the very transparent nature of Bitcoin itself. I'm pretty sure you can turn this into a dollar value easily. Sorry for the scrolling now. Here we go. Ukraine, various, some of my Bitcoins right there. Donated to them many times in Bitcoin. The two hegemons have the most, but combined less than MicroStrategy. It's unbelievable. It's truly unbelievable what Sailor has done here. And these guys, of course. Grayscale never had that much. And these guys took over a lot from there. So yeah, it's a great site. Bitcoin treasuries. Whoops. I'm going to switch away from this. Okay. But yeah, not sure what else you want to talk about today. This remains the main thing. This remains the main issue at hand. And you are now going to see these countries throwing their weight around behind how much treasuries they actually own. Okay, so China and Japan, of course, are the biggest, but Britain too. And Britain has a lot of equity investments. A lot of Brits in general are invested in the U.S. markets. As you expect, a wealthy nation would have a lot of its pension fund money inside of corporate bonds and stocks in the U.S. So that's all going to be part of the picture here as part of the trade deal. And I think, I'll try to get some better charts here because I think that's obviously going to be a huge component as how much this foreign money throws its weight around the United States, and not just in the debt. Okay, this is the debt. This is the debt story of foreign money, but it's not the only story. I would love to get I guess just for comparison, and I'd only show the percentage, but maybe the total percentage here of equities and corporate bonds that foreigners have in all U.S. markets. Just as another percentage, it would be interesting to layer over. But I don't think I have much else, guys. So unless you want to see another chart, this is how it all comes together. And if you would ask me about a default, I think the same story remains as always. The United States is never going to meaningfully default. I mean, it's never going to do a hard default. It will just keep printing money to not default. And, the story to leave you with is there's room to go back. Right? We are not at, some newsletter writers, I'm sure, are in your inbox today telling you that this is the end. There's plenty of room to go back to this 28% of Federal Reserve owning U.S. Treasury debt, and there is room for Trump to negotiate, or Bessent rather. I guess Bessent is now the lead sort of on, he is the Secretary of the Treasury. There's plenty of room now to talk about the capital formations of these entities that do trade with the United States, and they could go back to their 34% from the current 24%, 23.5%. Thank you, RV. Appreciate it. And everybody for watching. Let me know, as always, if you have any comments, and feel free to donate. I don't want to say that too much on this. This is actually the most I've said that, but yeah, I'm happy to do this stuff, and hope you guys enjoy it. Have a great weekend.